1 p.m. on the East Coast, the 6th of September. Now, Carter, before we get into this, back in my commodities trading days, each month had a letter that was associated with it. So for September, the letter was U. For October, the letter was V. The problem, of course, is when you're writing things down quickly and speed is of the essence, U's and V's became very similar, obviously. You know, U, V, they all sort of looked alike. So the geniuses down, and they were brilliant people, by the way, on the floor of the exchange, instead of writing a V, they would write an upside down V. And that would be October. That's a little inside baseball shit that nobody probably cares about it. But this is Market Call. Carter Worth, Guy Adami, Dan Nathan not with us today, taking a much needed and deserved day off. Today's Market Call brought to you by FactSet, financial data and analytics powered by tomorrow. I'm powered by a number of things, Carter, not least of which the fact that you joined us last night on the set of Fast Money. Now, what a lot of people don't know, you're an original, you're an OG, man. You were doing this shit all through 06 too. I mean, I knew Carter Worth long before I knew a lot of these people. So it was great having you on.
You know, my favorite was always saying Christmas crude. That's a Z, of
Christmas
course.
crude.
Christmas crude. It's always a liquid, more liquid than October or whatever. But anyway, and then there's always that fun part going out to the following year, right? And then, you know, it's
red. That would be red Dees.
Yes.
And of course, December is the letter Z. All right, listen, we could talk about this all day, and I would, by the way. Maybe we'll do a show about it. But let's just start off with what people are talking about. And it starts off with Marko Kalanovic of JP Morgan talking about the potential for some volatility to be coming. And I think, listen, this is echoing a lot of the things that I think you've brought forth over the last, few weeks, month or so. And now Marco's on it. And it's, listen, 24 hours or one day does not a trend make, but it's playing out today. A lot of the things that we've been talking about and that have not had impact on the market to date are seemingly having it all in one day. But here we are talking about the potential for, his words, not mine, interest rate shock, consumer credit, funding of impact on employment, all the things that we're talking about. And he's sort of echoing, or he's bringing to light in his note this morning.
Yeah, I mean, obviously, we were always left with this. If you think about it, the rate on 10-year treasuries is exactly where it was essentially a year ago, right? We're in October at the peak. And yet that was the low for the market. So equities, rates are where they were when equities were, 20% lower. The question is, it's always about the rate of change, right? So a year ago, we were spiking ever so aggressively from basically, 1, 2, 3, all of a sudden above 4%. There was a great re-rating of equities. Now, interesting, we're at the exact same level, 10-year yields at 4+, but equities, of course, are well off their lows. The thing that never squares, right, is extrapolating rate of change. When oil spikes, right, because of the Ukraine invasion, Wall Street starts putting out reports about $250 a barrel if this really gets out of control. Well, no kidding if it gets out of control. That's but it never seems to. And so the question here is, if one is trying at a calm, deliberate, measured way, trying to figure out what Apple, for instance, is worth 3 years hence, and trying to figure out what its future cash flow is and what discount rate to put on it. Does the cost of 10-year money at 3.8 or 4.4 matter? Not at all. But that is the vagary of Wall Street. We have this circumstance where it's always this knee-jerk. And so, again, speaking about rates, the fact that just 4 or 5 weeks ago, there was talk of, recession. Oil was at $65 a barrel. Rates were, back at 3.75. Now, all of a sudden, it's higher for longer. It's always so fickle.
It's incredible. And I'm just reading through some of the comments. Again, I get a kick out of it. I'll highlight some later. But you brought a bevy of charts. I don't know if that's 2 V's or 2 Y's, but it means a lot. So let's go through them. It starts with the S&P.
Yeah, this is just something we just actually tweeted out for fun, in the sense that and it was about what a bloody waste of time. So let's put some lines in here. What we know is that basically from the first days after Labor Day versus 2 years ago, we have made no progress. And one could say, well, what's the point? The point is that this is a risk asset. If you look at the next iteration, over the past 2 years, the best you've had is you're up 7%. You've lost as much as almost 23, only to be returned to where you were. That on a risk-adjusted basis is about the worst thing you could do with your money. I mean, the worst thing, right? There are very few investments. If put it this way, if someone came to you, I've got this great opportunity. Well, what is it? Is it a hedge fund? Is it a new family? Well, I'm not going to tell you what it is, but here's what you're going to get: 2 years unch. At one point you'll be down 23. At one point you'll be up 7, but you'll get your money back at the end of it. No one would sign up for that. And so the question is, from here, are we really on the cusp of great returns and meaningful upside, or is it likely to be more of this, a bloody waste of time? I think that's the real risk.
And it's interesting. I agree with you. And I'm reading some comments, and somebody said, well, what if you bought in October 2022? Well, congratulations. You were that one person that obviously were able to buy the lows. And everybody in retrospect are those people. The oddity of all of that is, there were 2 times we were bullish last year. I remember both of them. It was June, the middle of June of last year, when the VIX spiked up to about 34.5, 35. And we talked about that being a moment in time where, okay, the risk reward set up well to the long side. And we actually said the market could rally probably 16, 17%. I think it actually rallied more than that. And we got bullish again in October for the same reasons. The same set of things were put in place. The VIX really was spiking. I think, a matter of fact, on a Monday in October, that some of the commentary was China uninvestable. So we're hearing a lot of the same types of things, and we thought, again, the market was probably on its way for another similar rally. What I got wrong from that point on was the fact that, in December onward, the fact that the market continued to do this creep higher. And we've talked about that a number of times. So anyway, there you go. But here we are in this point in time, and you've brought your charts, you've drawn the line. So let's take a look at them.
Yeah, just in terms of the what if, there's language and words that are not relevant in a lot of undertakings and endeavors. Like, what if after high school football, I played in Athens, Georgia, and then I played for the NFL? What if? I mean, what the hell does that mean? What if you bought at the bottom? What if you sold at the bottom? What if you bought? We're only all as good as our last trade, and we've all got bad ones and good ones. But talking about what if, there are no what ifs. There's just, over time, can we try to prosper by applying techniques and rules? And then at that point, it is a risky business. But let's look at the lines as they draw themselves. So here's the S&P from the what if low. Go ahead, let's put it in. That's a mathematically parallel channel. I didn't manipulate the lines. They are what they are. And if you put some arrows in, basically like a pinball machine, we've been sort of ricocheting off the bottom, off the top. Now that red arrow, of course, is a judgment. I think ultimately we will get close to the lower band. And the question here and now is the S&P as a bet, looking out 3 to 6 months, or 3 to 6 hours, or 3 to 6 weeks, wherever you are in the market and what's your preferred time frame? Is it a better buy or a sell? I think it's a better sell here than a buy.
I agree with you. And people will say you guys are living in your echo chamber. I get it, but there are a number of reasons. It's funny. Doug Cass put out a great piece. I know Doug is watching right now, and we will have Doug Cass back on. But he made some observations, some of the corollaries that he's seeing between 1987, the fall of '87, and some of the things he's seeing now. And you can say, "Oh, you guys are being fear mongers and that stuff." Well, no, we're just trying to point out some of the things that are happening now that happened then, and the things that people were not taking into consideration. We're just sort of saying that's not a big deal then. You have similar voices now saying none of this stuff is a big deal. I'm of the belief that a lot of this stuff is a big deal. Until the last whatever week or so, the market seemingly doesn't care. I think there's going to come a point where the market does care, and I think the chart you just drew bears that out. And I think you would say, Carter, we are still in an up channel since the fall of last year. The highlighted area suggests exactly that. So we could trade down to 4250-ish, 4300, and still be in this up channel. I think there's something more dire that's going to happen, but let's just do the here and now. up channels in place. With that said, you see movement to the downside in that channel.
I do. That's my hunch.
Let's take a look at yields. And this is a conversation we had last week. And again, your chart is still intact. I want to be clear. The movement in 10-year yields from 436-ish down to 405-ish, back to, I think today we're either side of 430. I think we're 429.5 or so. Dramatic moves in a short period of time. But let's go through the charts that you brought, because I think what you'll say is nothing has changed. These tops are still in place. Obviously, until they're not, and we go ratcheting through, or until they break down here. So let's talk.
Yeah. Well, we have 2, 5, 10, and 30. Let's go through quickly, and then we'll go back. 2, 5, 10, 30. And what do we know? It's all the same damn setup. Of course it is. So the question is, leave it on 30 here. Why not? Do we ultimately exceed the year ago highs? And again, to think about it, just to put it in context, we are at the same level now, call it 4.5%, as we were in October. That's 11 months ago. And yet that October, we were at 4.5. The market was at a low. Now S&P is well off that low because it's about the rate of change. In October, people are extrapolating, 7% right away. Now here we are a year later, and we're still at 4.5. The question is, are we going to 7%? Do we really break out? I don't think so. Again, that's subjective. That's a judgment. And that's mine. A lot of people, there's record shorts in the treasuries, as you know, as in positioning in the futures. Basically, the consensus is higher yields and meaningfully higher yields. We shall see. My hunch is otherwise.
It's it's again, the commentary is just fascinating to listen to. And somebody has a question about Tilray, and if you can pull up a Tilray chart real quick, because it has bounced recently. I mean, obviously this stock was dead in the water for a long time, so I don't know if we can do real time. What I'll say though is this: Erwin Simon, who runs Tilray, if you go back and look at his history with brands, he was at a company called Hain Celestial a year ago. He's made acquisitions, I think, recently, and don't at me if I'm wrong, because this is the first time I'm really thinking about it. I think they bought 8 of Anheuser-Busch's properties a month or so ago. It might have been a little bit longer. So Tilray is definitely in the phase where they're making acquisitions strategically. So if you believe in Erwin Simon, if you believe in his track record, yes, the stock has had a significant move. But if we could go a little longer term out, you'll see in the context of where it was and what it's been doing over there you go. So I just want to be crystal clear. I mean, despite the move, if you look at this over time, we really haven't done all that much. But I do agree that in this environment, Tilray might be interesting. And going back to yields real quick, I think yields are going higher. I think yields are going higher for the wrong reasons. So if yields do go higher here, I don't think equities will like that. Conversely, though, and I think Carter just quickly opined on this, if Carter is right and yields have topped out here and start going not dramatically lower, but starting to do the grind lower, one has to ask themselves, what is happening to make yields go lower? I would submit it could be one of two things, or both those things. It could be in a flight to quality in the form of treasury bonds and maybe the US dollar if the market is selling off, or yields are going lower because the economy is sort of grinding to a slowdown. But neither one of those, Carter, are obviously equity bullish. Thoughts on that? Am I in my own echo chamber, or am I looking at this the right way?
That's it. I mean, rates to move meaningfully in one direction or another have to have some force causing that or some theme. And surely, I mean, look, there's a case to be made, right, that commodities moving, oil, for instance, just of late, even though the dollar is strong, oil bucking that, but OJ is at multi-year highs, sugar, cocoa, that there's going to be more inflation for longer, and that basically the Fed is not done, and that rates have to do 6.5%, 7%. But if that's really what's coming, the odds of the equity market sort of hanging in are very low.
And it's interesting. So here's a comment. It doesn't have to be a crisis for people just to buy bonds, too black and white. Okay, I'll play your reindeer game. Historically, that's probably been true. But now with what's going on, I think, and again, this is just my opinion, for people, for the participants that matter, let's put it that way, for the institutions, for the driver of things to buy our bonds, you need to give them a higher rate of interest. In order for them to take on the perceived escalating risk, there has to be a yield associated with it. And I think part of the reason yields are going higher is because the market is demanding a higher yield in order to buy those bonds, which personally, Carter, I don't think is particularly bullish.
And also it gets to money flow, right? I mean, at what point is the yield attractive or attractive enough for a player thinking out 3 to 5 years to reduce some of exposure to equity into treasuries? Or of course, then there's the 5.5 trillion in money markets that are enjoying very handsome yields. What gets that money off the couch? These are unknowns. But right now, all things held equal, buying 1-year paper is a pretty good deal, risk adjusted versus a lot of individual equities.
The one thing that I've watched correctly at times, incorrectly other times, is the high yield index, the HYG, and you brought a chart here. So I have been concerned, and again, this is just my opinion, that credit, the put in the market, if there is a put, is for the Fed put, is not in the form of the S&P. I think if there is a Fed put in the S&P 500, it probably comes in somewhere between 3,800 and 4,000. That to me is where the Fed would get concerned about the equity market. Again, that's just my opinion. I think there's a Fed put in one of two places. In the job market, and that's going to come in the form of the unemployment rate going somewhere between 4.5% and 5%. I think if unemployment got there, it would wake the Fed up and be, okay, our job is done. Maybe we can start to backpedal or go the other way. Or worse, in my opinion, would be to something happen in the credit market. And the HYG sort of 74 has been a level, sort of this line of demarcation where it gets a little bit dicey. We've traded north of 75.5, 76 recently. We're back to about 74 and a quarter-ish, I think. But here we are. So thoughts on the HYG, because you brought some charts as well.
Sure. I think it's going to be 4 or 5, mostly identical. But the first thing is this is an all data chart. And the first thing that's elemental, that's obvious, is that basically it peaked back in what is 07? That's the S&P high before we went to the financial crisis. And that credit quality, and many fixed income analysts would make this point, that credit quality in America and in many of this kind of low quality companies is continuing to deteriorate and has been doing so for the better part of 15, 20 years. But if you look at the next chart, and let's toggle, so let's go back to the original one. Basically, those spikes, when you get those plunges, yes, those plunges quickly are reversed. So it's down and then snaps back, a little bit like VIX, but that's not happening this time, right? We're not spiking and ricocheting. We've spiked lower, of course, associated with the 2022 sell-off, and then we're kind of sitting here. And so the question is, where from here? The first thing I want to point out, though, is this is different. And so if you look at this same chart drawn a different way, we're really at a standoff. And if you put some arrows in, and I made them purposely this way, I think it's jump ball. If you look at this really up close, telescoped here and now, right, there's nothing in that chart that indicates which way it will be resolved, other than to say it is one heck of a moment of tension, and you can feel it. Now, basic principles of charting, you get to the apex, the formation, and you run out of runway, right? You can't, so something is likely to happen. My bias is down, we shall see, based on the long-term chart of HYG or JNK, but it is a perfect moment of equilibrium. Buyers and sellers matched off. Something will come along to unlock the standoff, but for now, equilibrium.
So let's go back to the first HYG chart, because you're right to point out that each time we had one of these events, and maybe you could bin the chart where it illustrates that violent move higher we saw in the back of it. Each time that we saw these moves to the downside, the subsequent bounce, the Fed jumped in, right? And I can look at history and say, I know what happened here, I know what happened here. Makes sense. Different this time, and the reason, again, Carter, my opinion, is why we're sort of flatlining here and not having that precipitous spike is because the Fed's not there. As a matter of fact, it's counter to what they did all those times ago. Thoughts on that real quick?
Well, that's right. And each of those things that we're just working backwards, the 2020 plunge is COVID. The 2015-16, that was an earnings recession and an industrial recession, negative. We know the 2011 was the flash crash. And of course, 2008, 2009 was the financial crisis. But this time it does have a different look and feel. Also, all within the context, and the darn thing peaked in 2007.
It's fascinating. I think, I'm not suggesting people should trade it. I think we say that all the time, but you should definitely watch it. So, anatomy of a trade. I love this. You brought with you another slide. So let's sort of break this down, because I think this helps. I think this is very helpful for folks.
Well, this was a sort of this week we did a pressing the energy bet, which is a follow-on to the August 22nd sticking with energy, which itself was a reiteration of the original July 10th, all things energy. In July, energy was out of favor. Oil was at 68, 70 a barrel. And we just took a shot. It's played out nicely. Sometimes you get a little luck and a little good timing. And so this week we wanted to reiterate that, just to press it. So let's look at the charts and see what we can see. This is oil, and I've tried to annotate for clients, which with reporters, that at 7:10, the July 10th judgment to buy oil, that was dodgy. Yes, we were at 68 a barrel, and there was nothing really but here's what we were picking up on. There was so much talk of recession, oil's going to go to 50, and it was the same extrapolators up at the high. When we were at 130, Wall Street started printing targets of 250. This is it, nuclear war with Putin, oil will seize up. And then at 65, it got the other way. We said, you know what, we're down 50%, oil's down 50% from its high. Let's take the road less traveled. And so the July and then the August. If you look at the energy chart for the XLE, it was because we were at the lower band of the trend line, right? And then playing it back. But now we're breaking out. And I do think there's also this. Energy, XLE, of course, is the S&P 500 energy sector. But is it really a sector? All of energy is 4.5% of the S&P. And two stocks, Exxon and Chevron, are almost 50%. So you could say, is it a sector? Well, you say millions of jobs and lots of companies. But the whole sector, as it stands, is only 4.5% of the S&P, and two stocks are basically half of the 4.5%. But energy has been as high as double digits, 9%, 12, 15% of the S&P. In 1980, it was the most highly weighted sector. I just think it's going to be more than 4.5% of the S&P.
I agree with you, and we've said this for a while. If you watch Fast Money, if you watch on the tape, anything, or listen on the tape, anything we do, we've been pretty steadfast in the energy, and it did not look particularly good a few months ago. OIH traded down, I think, 245, and I get it. It probably coincided with that move down in oil, but here we are back on the horse. And XLE, if memory serves, I think the all-time high was either side of $100. We're probably 91 and a half now. I think that goes higher. And OIH is making, at least yesterday, I don't know about today, making multi-year highs. And that has a lot of runway left as well. So I think if I'm right, again, a lot of ifs. We don't say it's certainly anything. But the way I look at the world, if the market is going to sell off the way I think it will, and probably be led by high valuation, high growth names, you're going to see, I think, this re-rotation into the energy space, Carter. So I'm totally with you on this one. And you brought some individual stocks with you as well in terms of the charts.
Yeah, I think you want to play it thematically, but what I thought we look at is a strong stock and a weak stock. So Hess is a strong stock at 52-week highs and multi-year highs. And the lines, I think, draw themselves, meaning do we or don't we break out? That green arrow is a judgment. That's mine. I think we do. By contradistinction, look at the second, a very weak stock. Talk about bombed out, 60 to 15. But if we put some lines in here, it is a textbook bearish to bullish reversal buy. And so I think one should barbell it, pick some of the strongest names, Tidewater, Diamond Offshore, and then double back and find some laggards that are now exhibiting impressive relative strength to the sector and bullish price volume correlation.
It's interesting. I'm reading the comments again, as my want to do. And I've said this on Fast Money. I've said it here, and I'll say it again. I think for the energy sector, three things happened that I think accelerated these moves higher. The first thing, let's put it this way. The first thing was probably ESG. I think the best thing counterintuitively that happened in the energy space was the advent of ESG. It forced so many of these companies to basically operate their businesses more efficiently. And that's been true with, as you said, the big cap integrated names, no question. It put a microscope under their ass, and it forced them to be better operators. The second thing that happened was that minus $39 front month print in crude oil. I want to say 3 Aprils ago. I might be off by a year or so, but I think folks that trade futures know when it happened. That really lit a candle under everybody's ass. And the third thing is the Biden administration. You'd be like, what are you talking about? Again, the fact that the Biden administration, this administration vilified this energy sector, once again, it forced them to just operate better and be better companies. So all those things collectively have made this space, to me, as counterintuitive as it sounds, very not only tradable, but very investable. And I think these stocks are going to continue to grind higher. I'm of the belief that there's going to be a reacceleration of inflation. I don't know if you share that, but I think it's going to manifest itself in the energy sector. And I think these stocks, Carter, all can be looked at, especially the levered names.
And remember, there's also this, it gets down to money flow. I can't tell you how many conversations with individual portfolio managers, both at very large long only as well as long short, who over the past 3-5 years, they're like, but I don't have to bother with it because it is only 2%, now 4% of the S&P. If you're a benchmark manager to the S&P 500, you can go to a energy conference and spend 3 days in Houston, listen to all those analysts, so you could say, hey, it's only 4% of my benchmark. So you'll remember in school, of course, when they'd say 40% on the final exam, 20% on the midterm, and then 10% on this paper, this quiz, or on this subject, you could just say, I'll forget that subject. I won't waste any time on it. Maybe I'll get a few points. I'll get it right. Meaning a lot of people just time efficiency, like I don't need to worry about a sector that's only 3 to 5, 2 to 4%. I'll own a little bit. But if and as it does start to move, which it has now, of course, you then draw money flow. And that's the issue. Does money flow ultimately get energy back to a weighting that's not, and it was literally sub 3%. It's now 4.5%. Does it get it to 6-7%? I think so.
Jack's asking a question. If inflation is going to reaccelerate, why is gold decelerating? Well, fair. It's a fair point. I think one of the reasons, as you said last night on Fast Money, I think, or on our show, as rates go higher, a non-interest bearing asset like gold becomes less attractive. That's number one. Number two, you've had strength in the dollar as well, which has created a bit of a headwind. And if in fact inflation is going to reaccelerate, it's odd when people start talking about inflation is exact probably wrong time to be in gold. I understand all of that. I would still submit, I think there's going to be a day in the sun for gold, and I think it's coming soon. Carter, you brought some comparable charts, I think, in terms of the restaurants and what you're seeing. And I think you don't like what you're seeing, particularly in the space.
Well, that's right. And you and I worked on this a bit last night, but this is what I'm hoping to sort of depict here is the really divergence between one area within consumer. If you think about the two best areas in consumer have been home builders and then sort of post-COVID travel stocks, hotel stocks, but also restaurants. So all experience stocks versus things, right? So we've got the S&P 1500 restaurant sub-industry group, which is McDonald's and Starbucks and Chipotle and Shake Shack and Wendy's, and it goes on and on, right? And Darden and what have you. But what we have here on a 10-year basis is that this area has tripled the performance of the general retailing aggregate as measured by the XRT, because you see what's been going on in Target, 52-week lower, Dollar General, and Foot Locker, all just one disaster after another. But the question is this very strong area of the market, is it starting to succumb? I think so. So let's look at not a comparative chart, but this is the actual S&P 1500, right, sub-industry group of 21 restaurants. And one way to draw the lines, of course, is to show that it's a false breakout. It tried to make a new high and couldn't. Another way to draw the lines, of course, is to make the point that it's broken trend. That's a very well-defined trend line in effect since the COVID low. If we put the first two charts together, This is not a good thing, right? You've got a sort of an attempt to make a new high, of failure, so a false breakout or a head fake. Now you're breaking trend. And if you look at the here and now charts, this is really where it starts to get dodgy. The actual restaurant group itself, this is now not a long-term chart. We are literally flirting with breaking that trend line. And if you put in the 150-day moving average, you'll see, of course, that we've now started to really roll over. We have all the elements of a bullish to bearish reversal in not only the aggregate, but a lot of individual stocks.
And that doesn't augur particularly well for some of the individual names. So you brought some of the individual charts as well. And what I said last night, we can sort of go to the first one here. It's amazing that Chipotle, CMG, is within earshot of its all-time high. And what I said last night, this is a stock we've been bullish on, but at some point, somebody's going to wake up and say valuation is ridiculous here, and valuation is going to matter. It's not happening yet. It's been a monster, but I think there's almost inevitability that it will. Anyway, that's just my 2 cents. Let's look at Carter's charts. Carter, go ahead.
Well, you'll see there from that one that Chipotle bounced off its 150-day, and so for now, a bit of a reprieve, whereas all the others are starting to undercut. And so we can move through them quickly because it's all the same circumstance. So if you see the McDonald's, right, it is starting to undercut its 150-day, and we can roll through chart, Darden rolling over. Take a look at Starbucks. Take a look at, and I can't remember what we have queued up here. I have a bunch, but I mean, the point is, this is not a good scenario for an area that's been so strong, starting with those very long-term charts. These are all, rolling over, and I don't like it.
Yeah, and it's interesting. A lot of the people are saying, what about China? What about China? What about Apple? What about Apple? Well, let's take a look at Apple. And there's obviously it's something we've talked about here on this show, and something I've been concerned about. Now, my concern has been unwarranted. I'd be the first person to say that. But what I've said for a while is it doesn't mean it's not going to happen. And we saw it. China bans allegedly, but now I think it's being substantiated by a number of different outlets. China bans iPhone use for government officials at work. That is an absolute salvo, without question. If China wants to escalate, they're going to do it, and I've said it. They're going to do it with some of the multinationals. I said the biggest bullseye on the back of a company finds itself on the back of Apple, and here we are. Personally, Carter, and I think you might actually agree with this, I'm surprised Apple's not down more today on the back of this headline. We'll see how it shakes out, but if you're looking for more worries with the geopolitical risk and the China-U.S. relations that are probably as poor as they've been in 5 or 6 decades, look no further than this headline, Carter Braxton Worth.
Yeah, it's a big headline, right? Because you can see what the next headline would be. It doesn't take a lot of imagination. And it's important to note that, remarkably, we're looking at a one-year chart here. Apple's strength, as impressive as it is, Apple's relative performance to the tech sector, to the XLK or whatever aggregate you choose, it peaked in September a year ago. Apple's been underperformed because it dropped so much during the 2022 plunge. The recovery, as impressive as it is, has still not recouped all of the relative losses to the sector.
Yesterday, Dan and Danny were in Chicago. They were at CME Group, and we teased something. We got a great response. So let's look at it again, Carter Braxton Worth. Battle of the Bonds. It starts September 10th. It ends on the 15th. For the first 100 people to sign up, and by the way, I actually think we probably surpassed that. So now we're just sort of doing it for all of our viewers, all of our listeners. We are going to send you a free water bottle. Market Call. Look at that thing. That thing looks, what do the kids call it? Dope? I'm not really sure what that is. CMEgroup.com/bonds challenge. Check it out. Sign up. I think you're going to enjoy it. It's a fun way. Listen, you're paper trading, but it's a fun way to see how things trade, to understand how futures trade, and to do it within that time frame, Carter Worth. I think it's really cool. And obviously CME Group does an amazing job, and I think this is something they're very passionate about. So, Carter, you and I both should sign up. I know Danny Moses is in because he thinks he's going to win the whole damn thing.
That's right. And it's a good-looking bottle. And it's a good-looking logo.
It is a good-looking bottle. Anyway, so that's it. Carter, you are the man. That's a lot of work in 34 minutes of time. Thanks for the heavy lift. Thanks, obviously, our audience. I want to thank FactSet Financial Data and Analytics, powered by Tomorrow. Thank you for CME Group for allowing us to promote that. I think it's going to be a lot of fun. We will see you tomorrow, Thursday. And I think EY from SoFi is back. And Butters, who's been like in Maine or something, or Michigan, I don't know where, he might be back too. So it's going to be a fricassee. We'll see you folks later.
See you.